From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrow. We do see a more constructive tone after yesterday's 1.2% sell-off in the Nasdaq. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, all eyes on Portugal as global central bankers meet in Sintra. The ECB ramping up its hawkish tone ahead of Chair Powell as big tech bounces after its biggest two-day slump since March. We begin with the big issue, climbing the wall of worry.
We have kind of a series of rolling challenges and headwinds.
It isn't a comfortable market.
You're seeing these cracks
under the surface.
Rising geopolitical risk.
Inflation is still elevated.
Central banks have seemingly become more hawkish.
More and more hawkish.
It does start to bite.
Recession risks are rising.
The recession risk is fairly high.
Many investors are looking past the turmoil.
This has been an incredibly resilient market.
Extremely resilient.
We're probably at one of those precipices right now where we're peaking in optimism.
The optimism may be overstated.
It's hard to be really positive looking forward.
These kind of recession headwinds are going to catch up with us.
Joining us now to weigh in is JP Morgan's Jordan Jackson and Tony Rodriguez of Nuveen. Jordan, we just heard all of those skeptics about the wall of worry and how markets just are completely resilient in the face of them. Do you think we're heading toward a tipping point?
I think we are. I do anticipate a bit of a volatility over the markets. You know, the reality is the recession is delayed but not denied. All of the reliable leading indicators continue to point to recession. When I look at the Conference Board's measure of CEO confidence, that's in the second quarter that hit 87% of respondents believe that a recession will materialize over the next 12 to 18 months. That is very little change from the same reading in the fourth quarter of last year. That was 85%. And so, again, I think businesses are preparing for that recession. The big question is going to be where the recession comes from. Seems like this is going to be very much more of a business-driven recession, maybe less so the consumer. And I think that keeps the recession relatively shallow if one were to occur. But again, we're seeing a lot of evidence of some slowing in labor markets, weakening in disinflation narrative beginning to feed through. And so I do think we're a little bit optimistic in terms of equity valuations right now.
Tony, are we heading into some sort of tipping point downward, or do you think that there is resilience that can keep going?
Well, good morning, Lisa. Good to be with you. So I say that it's a really combination. We do think that the economy is going to be more resilient than in typical slowing environments that we've seen in the past. And that's why our base case is that we're expecting to see a mild, shallow recession early in 24. Essentially, the idea is that a lot of the lagged effect of the tightening is going to begin to kick in. We think that tighter bank lending conditions are going to begin to kick in a little bit more in the second half. Consumers will finally get through all of their excess savings, and all that's going to lead to much more moderate growth, slower growth, eventually in our base case, a mild recession. But the point is that we don't expect to see a long, deep recession due primarily to the strength that we do see in the consumer balance sheet right now, employment markets, which, while we think they're going to weaken, will remain historically strong, and corporate balance sheets that are also in fairly good shape as we head into this slowdown period. So the market's a little bit optimistic right now in our minds, but we're definitely not expecting a very hard landing.
The key question for a lot of people has been what the Fed will do, what the ECB will do. We got a glimpse of the ECB earlier this morning, very hawkish. Morgan Stanley's Ellen Zentner overnight revising her outlook for the Fed's path ahead, writing, quote, "We now think that the Fed will hike in July. Our data forecasts have not changed, but our perception of the Fed's reaction function now points to a significantly lower bar to hike." In other words, we would need very weak data prints to convince the FOMC that its forecasts are wrong by the July meeting. Tony, do you agree with this? Is that your sense that right now, if the Fed has its way and nothing shocking happens, it's going to hike rates in July and keep them there for a very long time?
Absolutely. I mean, our base case is that you will see a July hike. We do think the bar is very low for that. However, as we move forward through the year, we do think that we'll begin to see that slowdown in both the growth data and moderation in the inflation data. And that could allow the Fed to just remain on hold with this one additional hike for the balance of the year. Now, if the data proves to be more resilient, inflation a little tougher to defeat here, as it has been so far in the first half of the year, then we could see one additional hike either at the September or the November meeting. But again, our base case would be that it's July and on hold for the balance of the year.
Jordan, if that's the case, how is the situation for bonds constructive, which is, I know, something that you've been talking about and many others would agree? How much have they priced in rates remaining around 5.5% for a prolonged period of time?
Well, a July hike is pretty much priced in. The challenge is when you look at the year-end Fed funds futures in the overnight swap market, it's right at about 5.25%. So markets are still, if the Fed gets 2 more hikes in, they're certainly pricing in some more aggressive cuts. I don't think they get 2 more hikes in. I'm much more in Tony's camp. I do think they go in July and then have to remain on pause thereafter. But I think bonds are going to high-quality core fixed income, I think is going to outperform equities over the next 3 to 6 months. When I look at the tail risks, do I think the equity market's going to continue to rally to 4,500 in the face of a more hawkish Fed? Probably not. But do I do think the Fed is at the, let's say, top of the 9th inning of a 9-inning rate hiking cycle? Yes, I do. And we're going to see signs, as Tony highlighted, that growth is going to be coming down. Inflation is going to be coming down. I think at the June inflation print, we're calling for a 3.2% year over year headline inflation number. That's some significant disinflation from the peak 9% year-over-year run rate in June of last year. I think you put lower inflation, lower growth, the Fed very close to being done. They're probably going to have to make a roundabout and start cutting rates potentially as soon as December. But certainly we think by the first quarter of next year, that all suggests lower bond yields, higher bond prices. It was interesting to see even after the hawkish FOMC meeting, you didn't see much movements in the 10-year. Right. And so when I think about the upside pressure, unless you get a significant recalibration in R star, or the neutral Fed funds rate, then I don't think you see another big move higher in long rates. I think, again, long rates are biased lower here. And that's, again, why I think I'm still more defensive and overweight fixed income now relative to equities.
And perhaps some of this story is that if the Fed does remain on hold and then even cuts rates, it comes in the heels of real weakness, potentially, that we see through earnings. Goldman Sachs' Peter Oppenheimer weighing in on the outlook for stocks with relation to the profit outlook, saying, well, we do not expect a recession. The outlook for profit growth remains subdued. We expect virtually no profit growth this year and mid-single-digit growth rates next year. The combination of high valuations and relatively slow profit growth implies a positive, albeit moderate, return for equities. Tony, I know your remit is really on the fixed income side, but how much do you see that this is the only logical solution, that if the Fed does pause or even cut rates and gives some wind to bonds, that means that the situation for profits in companies is going to be quite negative?
Well, we do agree with that forecast, and we think we're going to see profits slow down here as we move into the second half. We're expecting to see downward earnings revisions. Certainly, companies are going to hold on to some optimism here in the middle of the year. But as we get into the late third quarter, early fourth quarter, I think that's when companies will finally have to face the facts that margin pressures are going to increase in our minds. Pricing power is declining, we believe. So we do think we're going to see some slowdown in earnings, and that's going to be challenging for the equity market, given the levels that we're at. And of course, in that context, as Jordan pointed out, we think fixed income returns are going to look very attractive, because we agree with Jordan that we do think that rates here have peaked. While we may see some upward pressure in the near term, as we get to the end of this year, our forecast would be that you'd see a 10-year down closer to 3.25%, maybe a range of 3.25 to 3.5. So that additional tailwind of fixed income returns, we think, positions them, along with their very high starting yields here, to provide pretty attractive returns relative to the equity market through the next 6 to 12 months.
Meanwhile, markets are nearing the end of the first half of this year. The NASDAQ 100 is heading for its best opening 6 months to a year on record. But is it running out of steam? Joining us now is Bloomberg's Katie Greifeld with a look at what's next. Katie.
Well, the NASDAQ 100 up about 35% this year, among its best starts ever, like you say, and completely erasing last year's 33% drop, and a performance that really no one expected. Remember, at the start of this year, strategists were expecting a pretty much flat market. So the burning question now becomes, where do we go from here? You have the bears on one side saying that interest rates are heading higher from here, and thanks to AI's craze, you have just a handful of stocks that are pretty richly valued at this point leading this rally. Of course, you're thinking Apple, Microsoft, and Nvidia. On the other side of the trade, though, you have the bulls saying that this rally, it's starting to broaden out a little bit. You do have tech, of course, driving the bulk of it, but you also have sectors such as industrials, such as materials that are starting to join in, and that's typically a pretty good sign. And at the same time, you also have the earnings outlook, specifically when it comes to profits, starting to pick up a little bit from here. So that's the debate as we head into this second half, Lisa, and we'll see who wins out.
Katie, thank you so much. Jordan Jackson and Tony Rodriguez, both still with us, both agreeing that bonds are the place to be and that there is going to be a rally. Big tech on the heels of that is still a big question. Jordan, do you think that big tech will continue to rally? Do you think that it's poised to sell off more materially? Or do you think that it will fade into the background as less of a market driver than it has been during the first 6 months of the year?
Well, the big challenge with tech is that given its large weight in the index, it's always going to be driving the market to some degree. But I think the outlook going forward is probably more sideways to potentially a bit of volatility, maybe a bit of a correction in big tech. You know, the reason is, and even when we look at the earnings, it's been interesting. Over the course of May and June, you've actually seen net upward revisions for next 12 months earnings. And I think a big piece of that is markets are starting to look ahead to 2024. They're starting to look ahead towards a period in which the Fed is cutting rates, potentially trying to save the economy from a recession. And so I think obviously the AI craze today, potentially those earnings begin to materialize sometime next year. All that's sort of, I think, driving, helping to drive big tech higher. But importantly, earnings do not contract across sectors at the same time. I think tech, certainly big tech, you could argue their earnings recession was at the tail end of last year, beginning of this year. They've done a good job in fighting, protecting the bottom line, trying to keep those margins firm. And in that environment, we could actually see, tech keeping the earnings outlook, fairly robust. Again, given that they've done a lot of protecting of margins and still exhibit a bit of pricing power today. So that's why I think, you don't see a big collapse in tech shares.
Well, and to build on that, Tony, I'd love you to weigh in. There's this question about how important earnings are this particular year. Are we seeing this as the data that is most important to watch, more than economic data, to really indicate the next phase of market development?
Well, you make a very good point, Lisa. I do think that earnings for this balance of this year are going to be important given the run that we've had and given where valuations are. And what I do think will happen is that there'll be some support against seeing any kind of significant bear market because of the outlook for 24. When you're in an environment of the Fed potentially having to cut rates, where long-term rates, as I mentioned, we think have peaked so they no longer are a big headwind for equity valuations, that's when I think you can see a more stable market in 24 with earnings that finally settle in and begin to increase in 24 versus our expectation for 23. But when you think about the challenges from last year of rapidly rising rates, growth challenges, a lot of that's in our rearview mirror. And with the outlook for AI in the tech space in particular, we do think that there's some upside to stocks as we look out into 24. But a more challenging environment as we move through the balance of this year.
Tony Rodriguez, Jordan Jackson, both of you are sticking with us. Right now, let's take a look at the stocks moving ahead of the opening bell. Here is our own Abigail Doolittle. Abby.
Well, Lisa, it appears that the S&P 500 is trying to lose its worst six-day losing streak going back to the end of April. We do have some stocks popping higher. The future's up ever so slightly, helping out. Meta Platforms up 1.4%. This after Citi set a street high price target of $360. That represents about 27% upside potential from current levels. They also it's their top sector pick, and they raised their 2024 ad revenue projections. The stock ahead of this raise, Lisa, as you know, up sharply, up 131% on the year. Snowflake up 3.8% ahead of day two of Snowflake Summit 2023, reversing yesterday's session losses. The company has announced, you guessed it, an AI-related partnership with Nvidia, has the stock popping. Walgreens to the downside, though, really plunging down 8.7%, a messy situation. They missed the adjusted earnings by 6%, sales sales, there was a small beat, but as you know, Lisa, they cut their full year adjusted earnings forecast, and it appears to have to do with a slowdown in COVID products, along with, and this is a good thing, I guess, for the American public, less lung problems, but it seems like healthier people not helping out Walgreens.
Abigail, thank you. It is true. We should all cheer the fact that perhaps people are having less viral issues. Coming up, all eyes on the ECB Forum in Portugal.
It is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached.
ECB President Christine Lagarde kicking things off with Fed Chair Powell on deck tomorrow. That conversation coming up next.
It is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached. Bearing a material change to our expectations for inflation, we will continue to increase rates in July.
Central bankers gathering in Sintra, Portugal for the ECB's annual retreat. The main event coming tomorrow with the heads of the Bank of England, European Central Bank, Federal Reserve, and the Bank of Japan all set to speak. Joining us now is Bloomberg's Michael McKee. So far, it has been a hawkish tone from Christine Lagarde. What are we expecting tomorrow?
Well, probably more hawkishness, but a little bit more on the side of the Federal Reserve's outlook that we're going to see higher for longer. Now, here's what Christine Lagarde had to say that hasn't gotten as much publicity as her line about raising rates in July. Faced with a more persistent inflation process, we need a more persistent policy, one that not only produces sufficient tightening today, but also maintains restrictive conditions until we can be confident the second phase of the inflation process has been resolved. So she's telling the Europeans higher for longer, like Jay Powell. Now, the question is what the Bank of Japan will say. But Christine Lagarde has a problem that Jay Powell doesn't necessarily have, and that is the fact that she's dealing with 19 different countries that have different inflation rates. Germany is the so-called sick man of Europe right now. They're looking at inflation that is running at a higher rate recently than it has been, 6.3%. But look what they're expecting for Spain during the month of June, 1.7% below the ECB's target. So although core inflation is still running hot in Spain, you can imagine that there are divisions arising at the ECB. It also comes down, Lisa, to a fateful Friday because everybody's looking at the inflation forecast. And unfortunately, the four central bank presidents won't be having these in hand before they get to their speech tomorrow. But the Eurozone expected to fall a little bit, even if Germany is rising. US PCE expected to drop below 4%. But look at Japan. They're expected to go up. Now, that's what they want. So we're going to have some discordant central bank views, I think, tomorrow. And, of course, the Bank of England is pretty much set on the course of having to raise rates with inflation as high as it is there. But it will be interesting to listen to. But I think the main message for everybody is basically our current policy for longer.
Michael McKee, thank you so much. I'm looking right now, is distracted at looking at the Japanese yen versus the euro. And you can see just incredible weakness there on the heels of that divergence. Jordan Jackson and Tony Rodriguez are back with us. And as we do hear some of the divergent monetary policies around the world, Jordan, is your sense that the U.S. is a better or worse valuation just on a sort of currency basis than what we're seeing over in Europe?
Well, I do think that the value of the dollar is probably too high. I mean, the dollar came into the year still elevated. Obviously, we've seen a bit of weakness over the course of the year, but again, it's still quite high. When we look at interest rate differentials going forward, if the ECB, the Bank of England, are still talking hawkish and maybe have a little bit more work to do than that of the Fed, we probably could still see a bit of dollar weakness relative to the euro. Also, the outlook, I would say, for the euro area, given their, I would say, heroic efforts in rebuilding their natural gas reserves, probably suggests that they can very well avoid a recession and continue to grow through the end of the year and into 2024, whereas, of course, still the general consensus is for a recession in the U.S. And so I do think, you probably got a little bit more upside going global than I think staying in the dollar. And that's one of the reasons why we're overweight emerging market local debt. It's one of our highest conviction ideas over the near term.
Tony, do you agree? Is that sort of where your eye is overseas, perhaps even emerging markets?
Yes, we do agree with that, Lisa. So we think that certainly the dollar strength story was a 2022 story. We've seen some stability this year. We'd expect to see some weakness as we move through the balance of this year and into next year as the Fed does go on hold while the ECB has a bit more to do. And we think the Bank of Japan will also have a bit more to do than the Fed. And so that does lead us to emerging markets as being an attractive area in the market. Central banks there were ahead of the game in terms of addressing inflationary pressures. And of course, now the headwinds from that strong dollar begin to dissipate and from a tightening Fed begin to dissipate. So we think the story in emerging markets looks pretty good to us.
Tony, just quickly here, do you think that central banks will be able to have their cake and eat it to essentially be able to hike rates even higher and still achieve a soft landing?
They will if they only hike marginally higher, one more by the Fed, maybe two by the ECB. If inflation proves to be more persistent than our base case, then they have to go further. Then they won't be able to have their cake and eat it too. And I think our base case of a soft landing or of a mild short recession will prove to be a little too optimistic. And I think we'll see a harder landing both in the U.S. and globally.
Jordan Jackson, Tony Rodriguez, both of you, thank you so much for taking the time. We are about 7 minutes here away from the open, and we can see a bit of a positive tone coming up. We'll talk through some of the morning calls as analysts reset, and then later RBC's Lori Calvasina joining us at the opening bell with her outlook for the second half of the year. That conversation still ahead. Time now for our morning calls to look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs upgrading Kellogg's to buy, saying the company offers one of the few growth stories within the food sector. Next up, Citigroup raising its Meta price target to a street high $360, pointing to encouraging ad revenue trends. And finally, Bernstein downgrading Alphabet to market perform $125 price target, expecting tougher competition to cap near-term gains. Coming up, big tech rebounding after recording its biggest two-day decline in more than 3 months. We continue to see a build to the rally as we head closer to the open. That conversation coming up next with RBC's Lori Calvasina. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Farrow. Moments away from the start of trading, and we do see a bit of a rebound from yesterday's losses. NASDAQ up 0.4% after losing 1.2% at the close yesterday. S&P up by a lesser 0.2%. We can see in the bond market, the yields are going a bit higher as we prepare for what we expect to hear from Fed Chair Jay Powell, possibly echoing what we heard today from Christine Lagarde tomorrow. When he speaks at the Sintra conference. We can see right now on the short end, you could see yields up. On the long end, yields lower. 10-year yields 3.71%. And crude a bit off, 0.4% decline, $69 about traded on the NYMEX. Interesting to see euro strength right now on the heels of hawkish Christine Lagarde comments. One stock to watch at the open is Walgreens. Shares under pressure after slashing its profit forecast. The CEO writing, quote, significantly lower demand for COVID-related services, a more cautious and value-driven consumer, and a recently weaker respiratory season created margin pressures in the quarter. Joining us now, Bloomberg's Abigail Doolittle, who is talking about some of the issues with respiratory issues, good issues perhaps. Abby, what's the latest?
Well, the stock right now, Lisa, is heading to its worst day since March of 2020. So that's the degree of selling pressure that we are seeing for all of those reasons that you were just talking about. So relative to the quarter that they just reported, they did beat sales by about 3%, but adjusted earnings, there was a miss there. But it's really the outlook, the adjusted earnings outlook for the year that's weighing on this stock. As you mentioned, they cut it. The range is now $4 to $4.05 from $4.45 to $4.65. So it is definitely a cut. I don't know if I would describe it as a slash, though, but investors certainly not liking it. I think it has to do with the tone that you were just talking about, the company seeing dramatically less need for COVID vaccines, COVID treatments, less respiratory issues out there. So, again, good for Americans, good for consumers, good for people out there, but not so much for the company. They're also talking about the fact that consumers, because of the macroeconomic uncertainty, they're going more toward the value. I would argue, though, Lisa, this stock down about 63% from its peak back in 2018, not even the pandemic, that this kind of lumpiness for growth, both on the top and bottom line, basically low single digits for the top line and lots of uneven growth and lack of growth on the bottom line, it's not necessarily new. Investors not liking it. Again, the last I looked, the worst day since March of 2020.
Abigail Doolittle, thank you so much. Turning now to the airline industry, Delta boosting its profit outlook ahead of today's Investor Day, forecasting a record summer for overseas travel as it capitalizes on cheaper jet fuel prices and robust consumer demand. Joining us now is Chief Travel Correspondent Katie Greifeld. Katie, what's up?
It's a modest boost, but it's a boost nonetheless. Delta sees adjusted 2023 profit between $5 and $6 per share. That's at the higher end of its prior guidance, and analysts had been looking for about $5.81 a share. Now, this increase, like you say, it's largely thanks to expectations for international travel. We know that domestic demand has remained strong, and now overseas travel is starting to pick up. And like you say, Delta in particular anticipating a record summer for overseas trips. So we'll see how that plays out. But even with this morning's good news, Delta share is only up about 1.5%. They've been bouncing around a little bit. And Raymond James is pointing out that investors might have been looking for at least a 50-cent increase to its guidance. They didn't get that today. We're going to get the full picture when Delta reports in mid-July, but right now shares currently up about 1.4%.
Thank you so much, Katie. And I should note that Delta shares year to date up more than 33%. So perhaps also, again, that high bar. Turning now to big tech, another place of a high bar. Another day, another downgrade for Alphabet. Bernstein cutting the stock to market perform after UBS slashed its rating on Monday. The analyst warning about its rapid push into AI, writing, quote, from too slow to too fast. Google's aggressive push to integrate AI into core search results could create a near-term air pocket for advertising prices. Joining us now, Bloomberg's Ed Ludlow from San Francisco. Ed, what's the latest?
Yeah, good morning, Lisa. Bernstein, as you said, market perform from outperform. There's a lot of similarity in the commentary from Bernstein with regards to what we saw yesterday from UBS, which moved from buy to neutral. As you said, they're saying it's time to sit on the sidelines, although they do describe this stock as having been a warm hug and a favorite in the tech names for Bernstein. The problem is that as they shift towards generative AI, powered search, that will have an impact, as you flagged, near term on ad pricing, an air pocket on search ad pricing. It's interesting. We talk about this idea of consensus ratings or the ratio of buy, hold and sell ratings. For Alphabet, it's actually pretty high, 4.655 out of a reading of 5. But for this stock, that's the lowest level since April 2018. Of course, so much of the gain that we've seen year to date has been on the enthusiasm for AI-related names. Bernstein citing that is also a risk factor for this stock. And an example, a single name example, is to the market kind of taking a time out from the AI frenzy that we've seen. In the broader context of technology, the NASDAQ 100 rebounding slightly from its biggest two-day drop since March. And of course, last week was the biggest drop for that index since March on a weekly basis as well. So things shifting, but a lot of focus when it comes to the mega caps on the outlook for the Fed and higher rates.
And Google is heading for its biggest three-day decline since February. Ed Ludlow, thank you so much. Let's continue the conversation now with RBC's Capital's Lori Calvasina, who has been constructive for quite a while. Lori, fantastic to catch up with you. As we head toward the midpoint in this year, are you changing your view on your more constructive tone?
So thanks for having me as always, Lisa. And look, I would say we haven't changed our view. I would still put us in the camp of the more constructive strategist as opposed to the bearish strategist. That being said, once the S&P kind of poked its head above 4,400, I did notice a few of our models and indicators, things started to just feel a little bit murkier over the intermediate term. So that's probably the only shift in tone we're trying to put out there right at this moment. And I think it's best captured if you look at sentiment. And this is one of the things that had really kept us, really pretty far out of that bear camp for the first half of the year, was looking at AAII net bullishness, which had started the year down around financial crisis lows. After SVB, it went right back down there again. And that's typically a very strong buy signal for the market. You get about a 15% gain over the next 12 months. Well, what we've seen over the last couple weeks is we're no longer in extremely oversold territory. We're actually starting to creep back towards overbought territory. We've been at about 15% on net bullishness in favor of the bulls. And when you get to 30%, that's typically when you see flat markets over the next 12 months. Now, we're not there yet, but I'm looking at this indicator and I can see how we can get there within the next month or two. And so we just wanted to kind of put that out there that, this does feel like it's getting to be a little bit later innings at this point.
Where would the potential pause or even declines come? Are they going to be in the tech sector? Are they going to come in some of the areas that have already gotten beaten up year to date? I'm thinking some of the small caps. I'm thinking some of the consumer discretionaries.
So what we are noticing on small caps is that is a space, it's been trying to rally off the bottom, and I still like it very much on a longer term basis, but we are noticing that the money flows are starting to turn back in the other direction. Even though you haven't really seen the breakout there yet, money flows have been supportive, and we're starting to see that reverse a little bit. I would still stick with tech names. I do think that NASDAQ is getting a little bit overbought. If you look at the CFTC data, we're hitting new highs on NASDAQ mini positioning. That being said, I don't think you have to sort of throw all the growth stocks out at this point. A sector like communication services, where a lot of the internet names are, those earnings revisions are starting to weaken. They're actually staying stronger in tech proper. So I would tell you on the growth side of the market, be more selective there. I do think a sector like energy on the value side makes a lot of sense at this point in time, especially with rising geopolitical angst. It's been a cheap sector, slight improvement on earnings revision trends, nice dividend yields, and now we've got a little bit of geopolitical angst back into the market again. So I think that you really have to kind of spread your risk around. I think that you want to be very selective in these different buckets. I still like healthcare as a defensive bucket, especially if we do hit a little bit of a near-term air pocket in the stock market.
The distinction between being a bull and being a bear is getting more and more muddy. JP Morgan's Marko Kolanovic, who was strongly bullish last year, much more consistently bearish this year. The latest from him is, quote, "We expect a more challenging backdrop for stocks in H2 and believe risk reward remains unattractive given the decelerating economy and a likely recession starting in 4Q23 or the first quarter of 2024, softening consumer trends, investor complacency, and the significant re-rating of stocks so far this year." Lori, what's your sense about a recession call at this point? Have we pushed it out further than the year that people currently have any visibility into?
So if you look at the consensus stats on Bloomberg, they're still looking for the most weakness in GDP on a quarter-over-quarter basis in the back half of this year. We've really still seen those statistics continue to anticipate the start of a recovery in early 2024. And I do think that's probably the biggest risk to my call, is that this recession just gets pushed into next year. I am comforted by the fact, though, that I think whatever this is, whether it's a recession or a growth scare, I do think it's starting. We've started to see some deterioration in the labor market. We've started to hear companies, sort of talk about, especially on the goods side, sort of talk about some of that incremental weakness having come through. Obviously, there's also a lot of talk of resiliency, which I think reinforces the idea that this might just end up being a growth scare. But I'll tell you, Lisa, I think what's wrong in this whole kind of bearish recession needs to be priced in debate. Stocks are discounting mechanisms. This is, investing 101. And I do feel like a lot of my peers have forgotten about this. If you go back to the October lows in the equity market, the pricing was consistent with the 2023 recession. The language that people were using to get us to that low in October was all about how the Fed was pushing us into a recession with those aggressive rate hikes. And so I think we've already paid for a recession. Now we're just starting to see whether or not we get it. I think what the market is baking in right now, whether you're looking at earnings or GDP, it's baking in a 2024 recovery, a weak one albeit. But I think that idea of maybe the recovery doesn't come through, that the recession extends, that's the risk to the market. But I will tell you, Lisa, This recession discussion is just so frustrating to me because I feel like the bears have forgotten about all the work we did to price it in last year.
And Lori, this is I love that you're saying this because so many people have come on and said that bonds are looking at the now and stocks are looking at the next year, and the next year looks better than the now. And for bonds, they're looking at a potential disinflation and softness coming up in the near term. Are you saying, Lori, that we could get a recession, or we will get a recession in your base case by the fourth quarter, and that stocks can still go higher from here, and even materially so?
Yes, and I think that, remember, I spent about 7 years of my career, Lisa. I've been doing equity strategy for more than 20 years, spent about 7 of it exclusively covering the small cap space. So I know that like the back of my hand. And one of the things that you always see is that riskier part of the market has an inflection midway through a recession and starts to outperform coming out. And so that corner of the market is very, very forward looking. We have a lot of information, a lot of models that have shown us that the small caps were pricing in a recession last year. But I think what gets, a little bit tricky is I agree with a lot of your other commentators, right? When I talk to people on the fixed income side of the table, I think that they are just on a shorter term time horizon. They're digesting the daily data points. They're looking to price things in on sort of a trade of the day, and there's nothing wrong with that, but that is their time horizon. And I've just even noticed as I talk to hedge funds in particular that they are a little bit more focused on that fixed income side of the equation than equities. I think equities are being driven by longer term money right now, which is patient and which, has frankly been trying to buy any dip that it can find to really get exposure to those longer term recovery trades. Now, the volatility that I think we might get in the back half of this year, some of the changes in leadership we might get, I think are going to relate to what the shape of that recovery does look like next year. But that's an entirely different debate than what some of these bearish strategists are talking about.
Lori, just quickly, because you do focus on small caps, I'm very curious to hear your view of a recent Fed paper that said that the amount of financial distress in non-financial firms has reached a level that is higher than in most previous tightening cycles going back to the 1970s. Some people say we haven't experienced that yet. Are you worried about that? Is that sort of a tail risk for you?
So I think we have to differentiate between smaller public companies and small businesses. And one of the things we've looked at in the public company Russell 2000 space, and it's interesting, Lisa, because I got a lot of questions on this in my investor meetings last week, is what do those balance sheets look like in small cap Russell 2000 type companies? And we have seen that just like their large cap brethren, they've been able to keep interest expense relatively low against sales. And they also have really been shifting more into long-term debt. Only 10% of Russell 2000 companies have average weighted maturities on their debt between 0 and 2 years. It's about 2% in the S&P. So it's obviously worse in small than large, but it's really not that bad overall.
Lori Calvasina, you're sticking with us, which is a good thing. Coming up, President Biden addressing the Russian rebellion.
We gave Putin no excuse to blame this on the West or to blame this on NATO. We made clear that we were not involved. We had nothing to do with it. This was part of a struggle within the Russian system.
From Russia to China and what's happening on the Hill, the latest from Washington, D.C. is up next. This is Bloomberg.
We're going to keep assessing the fallout of this weekend's events and the implications for Russia and Ukraine. But it's still too early to reach a definitive conclusion about where this is going. The ultimate outcome of all this remains to be seen.
President Biden paying close attention to the developments out of Russia. This is Secretary Yellen. Plans to visit China in early July, marking the first high-level economic talks with her new Chinese counterpart, while the U.S. preps investment curbs. Here to take us through all things geopolitics, Enda Kern joining us now. And just want to first talk about the lack of reaction to what's transpired over in Russia. And honestly, even in China, we're not talking about this, but they've been taking a much more controlling role in the market as they face off with a slowing economy. What's catching your eye that we should be more focused on that we're not?
Well, on the China side, very controlled messaging, Lisa, like you say. There wasn't much commentary at all when the picture in Russia was as unclear as it was on Saturday. We have had commentary since then, making it clear that in Beijing, they've said it's an internal matter for Russia. They've noted that things are calm. There was one comment from an official, though, that said there should be clear communications at all times, and maybe that's a hint that Beijing was unhappy that Moscow wasn't keeping it up to date on what exactly was going on there. But nonetheless, as you mentioned, China's trying to keep that to the sideshow. On the other hand, of course, we've got the slowdown in the economy, pressure in the markets there, but that's also about control. China clearly trying to keep a lid on the volatility there, and it speaks to the overall narrative of China's economy at the moment. The government's in charge and trying to manage this sort of steady slowdown.
And the irony, as we talk about China and we think about the housing market and all the leverage there and the inflation, that they don't want to reflate necessarily through their stimulus. Here in the U.S., we're looking at a housing market that supposedly saw a big hit from interest rates rising, but's been recovering. We just got data, home prices in the U.S. rising for a third straight month. How much is this a problem for a Fed that was looking for a long and variable lag effect to really hit housing hard?
The housing story is confusing here at the moment, Lisa, no doubt about it. I mean, to make the quick observation, obviously a housing crash would be a much bigger problem for the Fed, given the wealth destruction that would have on household income. So in terms of raising interest rates and trying to pull off a soft landing, the Fed would probably take where it's at. But nonetheless, it is interesting that despite the 5 odd percentage points of rate hikes, house prices are expected to keep cooling. It looks as though some people are saying they may have bottomed, maybe taking off from here, adding to the whole, the unaffordability complex, adding to the whole inflation demand story side of things. It's a confusing story because, as you know, a lot of people say, why would you look to sell your house at the moment and move if you've got mortgages locked in at a rock bottom rate? But of course, rents are also under pressure. There's a lot going on in the housing market. It does look like it may have bottomed for now, but I think we'll get a clearer picture over the months ahead.
And people are saying if rates stay this high for a very long time, it might change the scenario. And thank you so much, as always. Still with us is RBC's Lori Calvasina. And Lori, I'd love your view on the home builders and the dynamism that we've seen in the housing space at a time when this is supposed to be one of the harder hit areas for more restrictive monetary policy.
So look, I think the data speaks for itself, which is that we're starting to see after, a number of indicators sort of went down to typical lows, we're starting to see this recovery that's in place. And I think it just speaks to the underlying resilience of consumers and the consumer balance sheet and all the repair that was done during COVID. And by the way, just the fact that life does simply go on. And I think that the resiliency of the consumers has simply been underestimated this time around. And, we talk a lot about the World War II scenario, Lisa, sort of why we skipped a recession in 1945. And I'll give you the short answer, which is that there was a lot of strength in the underlying economy with consumers and with corporations, even though you did have technically a real recession in terms of real GDP declining and job losses. And markets back then were able to sort of focus on the big picture and sense that underlying strength. And I think this is a symptom of that underlying strength that we're seeing here today.
At a certain point, though, doesn't this mean that the Fed has to raise rates even further, Lori, and tighten that much more simply because of the lack of interest rate sensitivity?
I think that once we really start to see, and by the way, I think it's already started, but once we start to see more evidence that inflation is under control, I think the Fed is going to lose its rationale for those rate hikes. And I think at a certain point in time, they're going to get challenged on the idea of why are you pursuing this just for the sake of pursuing this? This is supposed to be something that addresses the inflation problem. And once that is under control, it looks like we're well on our way. I don't think that they're really going to have the case to keep pressing. And I think at a certain point in time, we have to all just sort of sit back and say, okay, the economy is okay, and it's okay that the economy is okay. Because of this Fed dynamic, there's been a reluctance to admit that, but it is possible the Fed is going to pull this off.
We have seen home builders rally. Are you on that camp where you see that actually continuing?
So look, what I talked about with the home builders, and we don't make recommendations on that space specifically, but they did turn around last year right around when the small cap stocks started to turn around. A lot of those two do tend to be sort of small to medium in terms of their market capitalization. And so I think that, very much like the Russell 2000 last summer, that part of the market sniffed out a recession pretty early. It was one of the early leaders in terms of pricing that kind of risk in.
Lori Calvasina, thank you so much. A pleasure as always. Right now, let's take a look at some of those sectors. We get to Abigail Doolittle of Bloomberg with a breakdown of what's going on today. Abby.
Well, Lisa, with the S&P 500 up about 0.3%, very light volume. We do have more sectors higher than not, led by consumer discretionary up 1%. We also have tech up 0.9%. To the downside, healthcare down 0.5%. Interesting, though, over the last 5 days, those big tech sectors, well, those are the ones that are dragging on the market. It's going to be interesting to see whether or not the market does what it did yesterday, start off a little higher like today and then reverse lower, and whether those big tech sectors that are down over the last 5 days, whether or not they can stay up on the session.
Abigail, thank you. Coming up, the market moving events that you need to be watching. That's next in our trading diary. Time now for the trading diary you need to be watching this week. Consumer confidence numbers coming at the top of the hour. The Fed unveiling the results of its stress tests on Wednesday. We'll hear from Chair Powell and other global central banking heads that day, plus Micron results after the closing bell. And finally, U.S. GDP and jobless claims on Thursday. This was Countdown to the Open. This is Bloomberg.